Hey everybody, welcome back to our channel, where today we're diving into the world of monetary policy. If you've ever wondered what central banks actually do, you're in the right place. So grab a cup of coffee, sit back, and let's get started. Monetary policy is the process by which central banks, like the Federal Reserve in the United States, manage the money supply and interest rates in an economy. Why is this important, you ask? Well, it's because these decisions directly impact inflation, employment, and economic growth. In a nutshell, there are two types of monetary policy: expansionary and contractionary. Expansionary policy includes increases in the money supply and a lowering of interest rates, which stimulates borrowing and spending. On the other hand, contractionary policy does the opposite. It decreases the money supply and raises interest rates to slow down economic activity and control inflation. The primary goal of monetary policy is to maintain price stability, which means keeping inflation both low and stable. This is important because high inflation can erode the purchasing power of money and create uncertainty in the economy. But it's not just about inflation. Central banks also aim to support economic growth and full employment. To strike the right balance, central banks often use a framework called inflation targeting, where they set a specific inflation target and adjust monetary policy to achieve it. By managing expectations about future inflation, central banks can increase confidence and influence business and household decisions about spending, investment, and saving. Now that we know what monetary policy is and what it aims to achieve, let's talk about how central banks put it into action. There are three main tools that they use. Tool 1. Open market operations. This involves the buying and selling of government securities in the open market to influence the money supply. When central banks want to increase the money supply, they buy government securities, and when they want to decrease it, they sell them. Tool 2. Discount rate. This is the interest rate that central banks charge on loans to commercial banks. By raising or lowering the discount rate, central banks can influence the cost of borrowing for banks, which then affects the amount of money circulating in the economy. Tool 3. Reserve requirements. These are the minimum amounts of reserves that banks must hold against their customers' deposits. Central banks can change the reserve requirements to influence the money supply. For example, lowering reserve requirements means banks can lend out more money, which increases the money supply and stimulates economic activity. Let's take a look at some real-life examples of monetary policy in action. Example 1. The Great Recession. In response to the 2008 financial crisis, the Federal Reserve implemented a series of unconventional monetary policy measures, including quantitative easing. This involved large-scale purchases of government bonds and other securities to increase the money supply and lower long-term interest rates. These measures help stabilize the financial system and support economic recovery. Example 2. The COVID-19 pandemic. In the wake of the pandemic, central banks around the world took swift action to support their economies. For instance, the European Central Bank launched the Pandemic Emergency Purchase Program, which aimed to lower borrowing costs and support economic activity during the crisis. As we've seen, central banks play a crucial role in managing the money supply and interest rates, which directly impact inflation, employment, and economic growth. Monetary policy might seem like a complex subject, but understanding its basics is essential for anyone interested in how the economy works. Thanks for joining us today. If you found this video helpful, be sure to give it a thumbs up and subscribe to our channel for more informative content. And don't forget to leave your thoughts or questions in the comments section below. See you in the next video.